Hello and welcome to Business 150 Chapter 8, Personal Finances. In this chapter we're going to take some of the material that we learned in the last couple weeks dealing with business accounting and business finance and turn it into or apply it to our personal lives. So first of all, a key term that we'd like to review is personal finance, and it's just as I said, the application of financial principles to the monetary decisions that you or your family makes. So we take some of those key concepts that we learned in the previous chapters and see how using those activities and those benefits or those activities can benefit us as individuals and families. So the first thing I'd like to talk about, because it's seen on television and in advertising quite a bit, is what's known as a credit rating. And a credit rating is a system that is used by those that are issuing credit to individuals to quickly assess your ability to pay back a loan. So when you go into a store and you buy something on 6 months, same as cash, or you want to buy a large item in a store and they have 36 months financing, these systems are used to determine if you are eligible for that program and what the risk of you being able to pay back that loan really is. So how do you build a good credit score, a good credit rating? As young college students, it's possible that you maybe don't even have a credit rating because you've never had a history of paying back loans, and we'll talk about that in a minute. But building a good credit rating makes important or helps you make important decisions down the road. So if you have a loan or a rent payment and you don't or can't make it on time, that actually hurts this credit score that we're talking about. And then that credit score, if it is too low, will hurt your ability to borrow in the future. It will also have you pay higher interest rates on loans. Somebody with a good credit score or a very good credit score will actually pay less interest than somebody that has a lower credit score. How is that credit score determined? Well, there are 3 companies that track and collect your debt and payment history so that they can provide a score to people who are looking to extend credit. And you see there the 3 names are Equifax, Experian, and TransUnion. And so these companies, it's their business to collect your payment history and provide a score to those people looking to provide you credit. So a good credit score, or a credit score in general, is between 300 and 850 points. And most people fall in the 600 to 700 range, 6 being on the low end of a credit score, and 650, 750 is considered a high credit score. Credit bureaus consider, as I said, the history of payment. If you have a credit card and you make a monthly payment, or you have a Best Buy card and you make your payments regularly, or the rent that you have at your apartment, they consider that payment history. They also look at how much money you owe versus how much money you make. And then thirdly, how long have you had credit history? So for example, yourself, if you maybe have 2 or 3 years worth of credit history, and somebody like your parents or myself have 20, 30, 40 years of credit history, that will have an impact on your credit score. The 4th thing is the amount of new credit. So when a person applies for new credit, whether it be a car loan or a new credit card, those type of things impact your credit score. And then lastly, as it says, the type of credit you use. So a mortgage, because it's backed by the home you live in, or even to a certain degree rent, is a different type of credit than if you're getting a credit card through a local retailer. Last point I'd like to make is the laws allow you to check your credit score annually, and more importantly, to check them at no charge. There are multiple websites, multiple applications where you can check your credit score annually, and then it's important that you do that, because if an error has been made or somebody failed to correct an issue, or in the case of one of my family members, what happened was they got a bill sent to the wrong address. The person didn't know that the bill was even outstanding, and as a result, after a period of time, it hit their credit score. Their credit score went down and down, and when they wanted to borrow money to purchase something, they weren't able to do it, and it was really all a mistake. So it's really important that you check it on an annual basis. How can you build good credit? Again, many students might not even have a credit score, so how can you do this? Well, the first and probably easiest way, assuming your parents are willing to do that, is to become an authorized user on one of their credit cards. So they can set up a credit card with your name on it and as part of your credit card, and then that payment history and their credit activity will help you from your credit score. If you can, get your own credit card. Now, there are student cards out there. They're not all that cheap, but it is one way for you to build good credit. And I want to point out that it's really important to get the right card for you. Today, credit cards have multiple benefits. Some are free cards, but don't have any benefits with them. The ones that tend to have benefits, like airline miles or free hotel stays or some of those things, tend to, in many cases, especially for somebody with young credit, have an annual fee for it. And if you're not going to use it that much, chances of you getting an airline ticket or a free hotel week or something along those lines is pretty slim, and therefore why pay that extra fee for something that you probably won't be able to take advantage of? Use that credit card for small occasional purchases. If you have a car, use it for gas or use it for potentially groceries. The reason I tell you that is because it then allows the credit companies to see that you make purchases and, more importantly, pay back those purchases on time. Avoid any big ticket items except in an emergency. Don't use it to buy new furniture when you really can't afford new furniture, or a whole new wardrobe when you really don't need or afford a new wardrobe. Just because you have the credit doesn't mean you should use it. Pay off the balance each month. This is extremely important from your credit score, as well as the amount of money that you'll pay, and we'll talk about that a little more in the future. Pay all your bills on time. The people you rent your apartment from, not if you're staying in school housing, but if you are actually living in an off-campus apartment, those people also track and report any issues with your payment of rent. And so if you don't pay your bills on time, even if you have a credit card that you do, it'll affect your credit score. Don't ever co-sign for friends. Co-signing says if they don't pay, you will pay. And if they don't pay and you can't pay, it will hurt your credit, just like if it was your own credit score. Do not apply for several credit cards at a time. That is a big red flag for the credit agencies. If you want to buy an electronic and you go to 3 or 4 stores and you apply for their credit card, that is a red flag and has a major impact on your credit score. And lastly, never use student loans for anything except for student education. Student loans tend to be large enough already for school. Using them for other things make it even that much worse. So credit card fees, there's normally a number of fees associated with credit cards. As I said earlier, there's usually an annual fee. Somebody normally needs to have pretty good credit in order to get a credit card that does not have an annual fee. There are some out there, but not always available to everybody. If you go over your limit, and credit card companies will assign a limit, they will give you $1,000, $2,000, $2,500 worth of limit. If you go over that limit, they will, in some cases, allow you to make that purchase, depending on your history. but then they will make a charge you for that. If you do not pay your loan or your credit card balance on time, all credit cards have a minimum payment. So if you don't make that payment on time, you will be assessed a late fee, and we'll look at that in just a minute as well. And lastly, when you use your credit card and you use it for a cash advance, today it's very popular for retailers when you swipe your card, first of all, to say, is this a debit card or a credit card? And the reason they do that is because the fees for the retailer are significantly less if you use it as a debit card. If you use it as a credit card and you say, I want to use this as a credit card, many times it will say, do you want any cash back? It should almost never, unless it's a real emergency, do that, because the interest on a credit card will start accruing from the day you take out that cash advance. And so if you have a credit card company with 20% interest, even if you pay that back in a few weeks or next month when the bill comes due, you will see cash advance fees, and it will be significant. A debit card, as I was just saying, doesn't create a loan. It helps you save and protect your spending because you just are taking money out of your credit card, out of your account. But you have to watch for overdrafts because banks tend to allow people to overdraft, but then they charge you for that. There are overdraft protection programs which allow, like, say, for example, if you have a checking account and a savings account, and you use your checking account and take money out for groceries or daily fees, and you do go over, it will automatically take money out of your savings and move it to your checking. Check with your banks. Some are very inexpensive or free. Other banks have a hefty fee for that service, and you have to make sure that it makes sense for you. Make sure you don't get into too much debt. If you do, cut them up, stop using them, reduce your expenses, and I'm just going to show you here in a minute how expensive it can really be. So this is a credit card statement. It has about $3,500 worth of charges on it. And part of the information on that credit card statement was the following. As you can see right here, it says that the minimum payment that has to be done is $72. It also says that if we don't receive your minimum payment by the date, you have to pay a late fee of $37. So your fee just went up by 50%, or not your fee, but the amount you have to pay. And then if you make no additional charges using this card and you only pay the minimum, and again it was about $3,500, it will take you 21 years to make that payment, or to pay off that $3,500. And that $3,500 will turn into an estimated total of over $15,000. You can see right here. So if you have $3,500 on your credit card and you only make the minimum payment here of $72, it will take you 21 years to pay off that bill at a total charge to you of over $15,000. If you make no additional charges and each month you pay roughly $250, well, that 21 years drops to 3 years and only $9,000 worth of payments. And so the savings is roughly $6,000 or $7,000 just by adding some payments to it. And again, this is if you don't make any additional charges to that account. And so credit cards are valuable and they have a place, but you have to be very careful that you don't get caught up into using them to buy things that you just don't absolutely need, or that you can't pay back when the bill comes due the next month. It is just very, very expensive debt.